Welcome to the lecture on partnership accounts. In this lecture, we will discuss about introduction to partnership business and partnership final account, which accounts are to be prepared in partnership final account, reconstitution of partnership. Reconstitution means any changes in partnership business. It can happen in case of admission of partners, retirement of any partner, or death of any one of the partner. And dissolution of partnership business. Dissolution means winding up of the business. And insolvency of a partner. Insolvency means if liability of any partner is higher than his assets, then the partner is called as insolvent partner. In insolvency, other partners have to bear the losses. So we will discuss in the lecture. As we know that sole trading concern is a business organization in which only single person is the owner. But in case of partnership, all the partners will become owner. All the partners are the owner of business. So in case of sole trading concern, management, ownership and controlling belongs to only single person, the owner. But in case of partnership business, ownership, management and controlling power are distributed among partners. Even risk is distributed among partners, that is, profit or loss will be distributed among partners in profit sharing ratios. The capital will also be introduced by different partners, and the ideas will be more in case of partnership business, but in case of sole trading organization, there is limited ideas. So the requirement of partnership business emerged. So let's start with the introduction of partnership business. In simple terms, partnership is a relation between two or more persons who comes together to run a business, and ownership and management will be distributed among them. Indian Partnership Act 1932 defines partnership as, under section 4, definition of partnership is given. It is the relation between persons. It is a relation between persons who have agreed to share the profits of a business carried on by all or any one of them acting for all. It means partnership is the relation between persons, means two or more persons who have agreed to share profits of business. The profit and loss of business are distributed among partners, carried on by all of them or any one of them. It is not necessary that all the partners should participate in the management of the business, acting for all. Indian Partnership Act was introduced in the year 1932. Based on this definition, let's discuss some features of partnership. First point, agreement. Agreement can be oral or written, and written agreement is called as partnership deed. Deed means written agreement. Partnership deed contains name of business, registered address of partnership firm, name of partners, address of each partner, capital introduced by each partner, profit sharing ratios among partners, other conditions and rules such as interest on capital, interest on drawings, interest on partners' loan, and conditions in case of winding up of the partnership firm. Written agreement is more reliable to solve future disputes among partners. So agreement can be oral or written. Next is number of partners. Minimum 2 members are required to form partnership business, and maximum 50 members are allowed in partnership business as per Companies Act 2013. The maximum number of members allowed in case of partnership business has been changed and now 50 members are allowed. Previously, it was 20 members for non-banking business and 10 members for banking business. But as per Companies Act 2013, the number of partners required to form partnership business is 2 and maximum allowed is 50. Sharing of profit and loss. Partners can share profit and loss in the agreed ratio, such as 1:1 equal ratio, 2:1, 1:2, 3:1, and so on. Whatever ratio is agreed among partners should be mentioned in written agreement. Unlimited liabilities. In partnership business organization, the liabilities of each partners is unlimited. It means if the assets of partnership business is insufficient to pay off the liabilities, then each and every partner has to sell the personal property and pay off the liabilities. And if any one of the partner becomes insolvent, then the remaining solvent partners will become liable. So the liabilities of each partner is unlimited. Next is registration. Registration of partnership firm is not compulsory. It means the registration of partnership business is optional in India, but in some states it is mandatory to register partnership business. For example, in the state of Maharashtra or Karnataka, the registration of partnership business is compulsory as per the state law. The reason behind it is, as per Income Tax Act 1961, the partnership business organization has to pay income tax at the rate 30% flat on net profit. But in case of sole trading business organization, it means if partnership business is not registered, then all the partners have to pay as per Personal Income Tax Act. It means on the basis of slab rate. So the registration of partnership business is not compulsory in India. It is optional. But in some states, such as Maharashtra, from the year 2005, it has become compulsory to register partnership business. Next is principal and agent. The partners act as a principal for business and they act as an agent for other partners. It means the electricity bill or rent, salary to any employee, or other necessary expenses can be borne by any one of the partners from the money of business. So the role of partner is principal and agent. The partners act as the principal for business organization, the partnership firm, and they act as an agent between other partners. And next is dissolution. Dissolution means to shut down the business organization. The partnership business can be dissolved in case of death of any partner, insolvency, insanity of any partner, or if any one of the partner wants to close down the business, then he should give at least 14 days prior notice to other partners. So dissolution of partnership business can be done as per written agreement or by giving 14 days prior notice to other partners or other cases such as death of partner. For example, if A and B are two partners, in case of death of Mr. A, the Mr. B will not continue the partnership firm as minimum two member is required to form a partnership business. So Mr. B cannot continue the partnership business Hence, in case of death of any one of the partner, the partnership will dissolve. In case of death or retirement, it means if Mr. A wants to retire, in such case, the partnership will be dissolved. In case of insanity, insanity means if the mental condition of any partner is not working properly, in such case, the partnership will be dissolved. And in case of insolvency of any partner, the partnership form will be dissolved. So dissolution of partnership business can be done as per agreement or by giving 14 days prior notice to other partners, or in case of death, retirement, insanity, insolvency of any one of the partner. So agreement can be oral or written. Written agreement is called as partnership deed. Number of partners, minimum 2 and maximum 50 partners are allowed in case of partnership business, and minor person can also partner, but only in case of profit. Sharing of profit and loss among partners will be disclosed in written agreement, that is partnership deed. If it is not written, then it will be assumed that all the partners are equal partners. Means all the profit and loss will be distributed equally among all the partners. The liability of every partners is unlimited, and in case of insolvency, the remaining solvent partners have to bear the liabilities. Registration of partnership business is not compulsory in India. The partners act as an agent as well as a principal to business organization, and dissolution of partnership business can be done as per agreement or 14 days prior notice to other partners, or in case of death, retirement, insanity, insolvency of any one of the partners. The provisions of Indian Partnership Act 1932 provides that the profit of business will be distributed among partners as per agreement, or the profit and loss will be distributed among partners in an agreed ratio. If partnership deed is silent about the distribution of profit, then it will be assumed that they all are equal partners. It means profit will be distributed equally among partners. For example, if there are two partners, Mr. A and B, and profit sharing ratio is equal, that is 1 is to 1, then the profit will be distributed equally among them. For example, if 40,000 rupees is profit for current year, then it will be distributed among partners as 20,000 for Mr. A and 20,000 for Mr. B. And if the profit is 60,000 rupees and the agreed ratio is 2 is to 1, then the profit will be distributed as 40,000 rupees for Mr. A and 20,000 for Mr. B. If there are three partners, A, B, and C, and profit is 60,000 rupees, and if all the partners are equal partners, then the profit will be distributed as 20,000 rupees per partner. Let's take last example. If there are three partners and profit is 50,000 rupees and the ratio is 2 is to 1 is to 2, then profit will be distributed as 20,000 rupees for Mr. A and C and 10,000 rupees for Mr. B. So distribution of profit will be as per agreement, and if the partnership deed is silent about the distribution of profit and loss, then the profit will be distributed, profit and loss both will be distributed equally among partners. Next, Interest on drawings. Drawings means if money is withdrawn by partner from business organization for personal use. In such case, interest on drawing will be applicable as per agreement. But if the date of drawings is not given, then the provision states that the interest on drawings will be calculated for 6 months. Next, interest on capital. If partnership deed is silent about the interest on capital, then no interest will be payable to partners. Next, interest on partners loan. If any one of the partner has given business loan to partnership firm, then the interest will be paid as per agreement, and if agreement is silent about the interest, then 6% per annum will be payable. Next is salary and commission as per agreement, but if agreement is silent about salary and commission for extra work done by the partner, then no salary or commission will be payable to any partners. Admission of a new partner. If there are two partners or three partners and one more person wants to come to the business organization as a partner, then the consent of all the partners are required. Consent means permission of all partners are required. If any one of the partner is not permitting to admit Mr. D as partner, in such case, no admission will happen. So, as per Act, the provision states that distribution of profit will be as per agreement, but if agreement is silent, then all the partners will be equal partners. Interest on drawings will not be charged if agreement is silent, but if date of drawings is not given, in such case 6 months interest will be charged. Interest on capital will not be given to partner. Interest on partner's loan as per agreement, and if agreement is silent, then 6% per annum will be payable. Salary or commission to partner is not payable for extra work done if not written in agreement. Admission of new partner can happen only if all the partners give consent, and if any one of the partner don't give permission, in such case no admission takes place. What are the accounts to be prepared? In case of partnership firm, trading account, profit and loss account, partners capital account, and balance sheet. Generally, we prepare these accounts in case of partnership final account, but sometimes we also prepare partners current account in addition to partners capital account. So let's discuss the methods of capital account. Capital account can be prepared under fixed capital method and fluctuating capital method. Under fixed capital method, two accounts are prepared: partners capital account and partners current account. But in case of fluctuating capital method, only partners capital account is to be prepared. No requirement to prepare partners current account. In the absence of any information regarding method of capital account to be followed, then fluctuating capital method will be followed and we will prepare only partners capital account. All the adjustment will be done in partners capital account. In case of fixed capital method, the amount of capital at the beginning of the year and at the end of the year remains same. So all the adjustment will be done in partner's current account. All the adjustment means interest on drawings, interest on capital, distribution of profit sharing. It means no addition or deduction will be done in partner's capital account. And if we follow fluctuating capital method, then all the adjustment of partner's current account will be done in partner's capital account. In case of fluctuating capital method, only partner's capital account is to be prepared. So there will be debit side and credit side. On credit side, there will be opening balance of partner's capital account by balance brought down. It is previous year balance which has been brought down to current year. Then interest on capital, cash bank account if additional capital has been introduced. Here to drawings account if money is withdrawn for personal use by any one of the partner. To interest on drawings if net profit is distributed among partners, then it will be shifted to partners capital account from profit and loss account to partners capital account credit side. And if there is net loss, then from profit and loss credit account we will shift to partners capital account debit side. So if we follow fluctuating capital method, then all the adjustment will be done in partners capital account only. But if we follow fixed capital method, then two accounts are to be prepared. One is partners capital account and another is partners current account. Partners capital account will be credited by balance brought down, the opening balance, and the closing balance will also become same at the end of the year. The opening and closing will be same. It means there will not be any entry of adjustment. And all the other entries such as interest on capital, interest on drawings, net profit, net loss, salary or commission paid to any partners, then all the effects will be done in partner's current account and not in partner's capital account. But if any one of the partner has introduced further capital, then the entry will be in partner's capital account by cash and bank account. Additional capital introduced by any partner. So it was about method of capital account. We prepare capital account only in case of fluctuating capital method, and we prepare two accounts, partners capital account as well as partners current account in case of fixed capital method.